Hello friends. Last week we saw the markets turn nervous, especially on Thursday and Friday. Overseas cues were negative and that added to the worry. Is it possible that the overseas markets bring down the sentiments in Indian markets as well, which have so far been relatively outperformers? In this weekly video, I'm going to take up just that issue. You see, in my weekly live mint column, which I have been sharing with you on my Telegram channel, I've been writing since the last 3 weeks that I would prefer to square up my trades on the same day intraday rather than roll them over onto the next trading session. Last week's trading pattern would have underscored why this advice is worth its weight in gold. The kind of gap up, gap open, and the kind of trends that were changing at the turn and fall of a dime would have told you that carrying over positions to the next trading session is fraught with danger in such markets. Now, we basically plunge right into what to expect in the market in the week ahead. And on your screen right now is the market roundup window, which tells me that it was the Nifty 50, the broader of the two indices, which led the fall, whereas the Bank Nifty actually gained a little on a week-on-week basis. The US dollar index, the Dixie, rose by 67 basis points, which essentially was the prime reason why emerging markets, including India, felt the pressure. Bullion fell because the dollar is the invoicing currency, and if the dollar is strong, commodity prices tend to fall. Mercifully, so did crude oil and natural gas, which were also down due to currency and demand destruction fears. The US dollar versus the rupee gained 10 basis points, which basically was triggered by the fact that our forex reserves fell and our inflation rose. 10-year benchmark bond yields are up again to 7.27%. That was a rise of 12 basis points, and the NSE lost 1.24% in market capitalization on a week-on-week basis. MWPL rose, and the US markets basically saw a huge decline. And the broader the indices, the bigger the decline, which adds to the worry. Coming up on your screen is the daily chart of the Dow Jones Industrial Average, which fell on 3 out of 5 trading sessions. It's now trading below the 31,886 levels, which was a last mile support. And the death cross, where the 50-day average being below the 200-day moving average, remains in place. What we need to see is whether the 29,500 mark is violated on a sustained closing basis in the week ahead. The Nasdaq 100 index, which I told you has a direct bearing on Indian IT stocks, also saw a continued death cross being in place, and the bullish triangle support trend line is now conclusively violated. The previous swing low is also violated. For the Nasdaq's outlook to improve, it must trade continuously above the 12,898 levels, which is a long shot. Take a look at the broadest index of the three, the S&P 500. The bullish triangle is violated. The death cross remains in place. The price is below the 50-day moving average as well as the previous swing low. And for the trend to turn positive, the S&P 500 will now have to trade above the 4,178 mark. A long shot indeed. So the overseas cues are likely to remain weak. Can they drag the Indian markets lower? Yes, they can. So this is the first red flag of the week. On your screen now is the MWPL, or the market-wide position limits. This is a 2 marshmallow theory gauge of risk appetite. It's now at its highest in a 20-week period. And like I wrote in my mint column, this is a positive as well as a negative sign, because the MWPL is a gauge of risk appetite based on the fact that traders are keeping open positions to the highest level in 20 weeks. It also means that if positions turn loss making, the LIFO method, last in, first out in accounting, will apply, and the freshly created positions would be the first to get chopped out, which means that volatility can rise. Now, the stock and index futures turnover cumulative for all three expiries, which is September, October, November, what we are seeing is the turnover has hit the upper half of the 20-week range, coming on a week of deep declines in the Nifty and some amount of profit taking on the bank Nifty. This is a worrying sign. So there was ample amount of participation coming in. Could it be distribution? Yes, the possibility exists. For the futures basis is nothing but the premium or discount prevalent on futures compared to spot. What we have seen is the bank Nifty basis come down sharply, and what we are seeing is the Nifty basis has increased mildly. What it tells me is that the bank Nifty saw profit taking at higher levels, whereas the Nifty saw short covering cushion the basis on declines. So as long as the short covering remains, there is still hope that the bulls might just attempt to pull the market up, although the odds are long. But what we need to watch out for is basis inversion, which means futures trading at a discount to cash. If that happens, markets can decline faster. The advanced decline ratio on your chart now, 20-week look back period at 0.20. This is quite simply the lowest in many, many months. One marshmallow traders, the intraday players, were the most pessimistic in many months. Now, why is this? This is because of LIFO, last in, first out. The latest positions, the buy positions that they've created, they are now getting out of them because they've turned loss making. The positions that were initiated earlier and are profit making might still be held. So the LIFO method has created the second casualty. The first being the overseas market cues, the second being the advanced decline ratio. This is the second red flag of the week. Now coming to the impetus chart, which you have been trusting for over a year and a half now. Both the Bank Nifty and the Nifty 50 impetus rose. Coming on falling weeks, this is not exactly great news. It tells me that the momentum was higher in spite of the fact that prices have gone down. So the selling was forceful. The LWTD, the latest in the in-house indicators I've shared from a statistical trading model, the IBEX, is showing that the Nifty percentage gain loss line is at its lowest in 20 weeks, whereas the LWTD has also plunged to minus 0.26. That means that the falls are likely to basically create pressure on the bulls, and value buyers, bottom fishers, or people who average their long positions might offer very little support on declines. This is quite simply the third red flag. Coming to the footprint of the four market participants, starting with the FIIs, they've gone net negative in individual stock futures. And this is happening for the first time in the 20-week time frame. As far as their index futures are concerned, they've cut their short positions mildly, but do remember their shorts in individual stock futures are humongous. So that more than compensates. Where DIIs are concerned, they continue to cut their shorts in the individual stock futures because they support the prices in the spot segment, and they've also cut their short positions in index futures on a week-on-week basis, and it's because they are buying in cash that they are short in futures as a hedge. Where prop traders are concerned, they continue to raise their exposure to individual stock futures longs, but their index futures position are now net negative. So they are basically taking a very hedged and a cautious approach where their exposure levels are concerned. Let's take a look at what the retail segment is doing. They've raised their individual stock futures long positions to 11,45,000 lots. This is the second week in a row that their long positions in individual stocks are above a million mark. And they are now at a 3-month high. The index long positions have been pruned by approximately 23-24%, but they do remain net long. So the prop and the retail guys seem to be more optimistic than the institutional guys. I now come to the 4 index heavyweights that swing the index, and both the Nifty and the Bank Nifty in the case of 2 stocks with themselves. Starting with the biggest boy of them all, Reliance Industries, with a weightage of 11.51%, has fallen below the 2,542 level. That's going to hurt the Nifty without any doubt. For Reliance to proactively support the Nifty, it should basically trade above the 2,620 or 2,625 levels, which is a long shot because it's currently struggling to hold the 2,500 mark. Where HDFC Bank is concerned, it's fallen on Thursday and Friday, tested its 25-day exponential moving average, which is a month-long holding on cost of the bulls. In case of declines and the price staying below the 25-day exponential moving average, the bulls will clearly be at a disadvantage. So even though the picture is not as weak as Reliance is, but it's not exactly painting a very rosy picture. Infosys, with a weightage of 7.5% in the Nifty, falling in tandem with the Nasdaq. The technology sector has been taking a beating on the chin. I have recorded a video as to how tech shares need not necessarily rise with a falling rupee, which is a misconception that is being thrown around in the public domain. The hyperlink to that video is in the description and in the pinned comment below. So Infosys is unlikely to support the Nifty in a hurry. Let's now come to the 4th and the final stock. Quite simply, relatively speaking, the strongest of them all, ICICI Bank, supports the Nifty to the extent of 7.57% and the Bank Nifty to the extent of 23.72% weightage. In the Bank Nifty, this is the second highest weighted stock after HDFC Bank. Now, this stock has basically seen an inverted hammer on Thursday, as you can see on your screen, and on Friday, follow-up selling took it even lower, but it still remains above the 25-day exponential moving average, which is a month-long holding on cost of a bull. So, as long as the price remains above the 867 mark, I think ICICI Bank should be doing fine. Watch out for the 25-day exponential moving average as the first primary support. Friends, I now come to the bond market, which have a direct bearing on banking stocks, especially the Bank Nifty traders who need to pay close attention to bond yields. After falling for almost 2 months now, bond yields have jumped, as you can see on the weekly chart on your screen. This is one reason I have been telling you that I don't expect the 7% round number to be breached in a hurry. And 7.27 is a level that I will be watching out for very keenly. If at all bond yields start trading sustainably above the 7.27 mark, I think more trouble for banking bulls, especially Bank Nifty traders, because in addition to the US Federal Reserve's interest rate hike decision, the Indian Reserve Bank of India's Monetary Policy Committee, the MPC, is heading towards a meeting in which interest rates are likely to be considered. Should interest rates be raised in the US, that will increase pressure on the Indian MPC, the Monetary Policy Committee, to match the rate hikes, which might exert further downward pressure on Indian indices. This is the fourth red flag for the week as far as I'm concerned. Friends, I now come to the US dollar index, which is creating ripples in emerging markets, including India. And what we can see is that the dollar index has risen on 2 out of 5 trading sessions last week, but the gains that it made on Tuesday were enough to push it into positive territory. The price remains above its 25-day exponential moving average, which is a month-long holding on cost of an average bull. So the short-term outlook also remains positive for now. Coming to the weekly chart, what we are seeing is a bullish piercing pattern on the weekly chart, wherein the bullish candle has pierced the previous week's bearish candle more than 50% of the body of the candle. And the price is far above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. So the medium-term outlook on the US dollar index remains positive. That means more pressure for emerging markets, including India. Last week, I advocated a range between 110.90 on the upside and 107.05 on the downside, which held perfectly well. In the coming week, I expect a range between 111.60 on the upside and 107.70 on the downside. Do watch this index keenly because the outlook on emerging markets depends on this index. Friends, the dollar index done, I now come to the Bank Nifty, which basically was the outperformer of the week. And it gained 0.89% on a week-on-week basis. As the daily chart on your screen tells you, it rose on 3 out of 5 trading sessions. Thursday and Friday were 2 consecutive days of declines. And the gains that it logged on Wednesday were humongous. This is what you call a power candle, the largest candle in the recent times, and it basically was penetrated by Thursday and Friday, but the low of this candle is still not violated. What we are seeing is that the price remains above the 25-day exponential moving average, which is a month-long holding on cost of an average bull. So the outlook on the Bank Nifty at this point in time, as we speak, still has some hope. Unless and until the 39,500 level is violated on a sustained closing basis, the bulls are still going to attempt to bottom fish. Will they succeed? The coming few trading sessions will tell us. Take a look at the weekly chart on your screen now. What we are seeing is an inverted hammer, a bullish hammer on the weekly chart. This is another red flag as far as I'm concerned. As per Japanese candlestick theory, inverted hammer is formed when the bulls attempt to take the prices higher, fail, and the prices come to settle in the lower end of the range of that particular period, in this case the week. So it does seem that the bulls basically ran out of steam, ran out of momentum. And as I have been telling you in the past 2 weekly videos, although the price remains above the 25-week exponential moving average, the gap between the average and the price calls for mean reversion. Mean reversion would mean either the price comes down towards the moving average or it goes sideways and the moving average comes up to catch up with the price. In the best case scenario, this would call for a time-wise correction. In a worst case scenario, it would call for a price-wise correction. So a decline should not be ruled out. And which is why I said the inverted hammer is a red flag as far as I'm concerned. Now, in the week before last, on our in-house statistical beta rankings, this index was at number 4 in the volatility list. It remained at number 4, which is pretty high considering that it's a sectoral index and therefore high volatility may be expected, which is a challenge for the bulls, the retail traders, to tackle with. Last week, I advocated a range between 41,950 on the upside and 38,875 on the downside, which held perfectly well. Do note the high was at 41,840, which is a mere 110 points lower than the resistance level that I had advocated. In the coming week, I expect an estimated range between 42,300 on the upside and 39,250 on the downside. Friends, keeping in mind the statistical beta or the volatility, trade very, very light. I've as it is been telling you to trade light, but now I would tell you to trade very, very light. Friends, the Bank Nifty done. I now come to the Nifty 50, which led the way down by falling 1.70% on a week-on-week basis. It fell on 3 out of 5 trading sessions, as you can see on the daily chart on your screen. The falls on those 3 days were much bigger than the gains on the remaining 2 days. In the case of the Nifty 50, the price has fallen and closed below its 25-day exponential moving average, which is a month-long holding on cost of an average bull, which means the short-term outlook has been weakened. This is the next red flag as far as I'm concerned. Also, look at the 18,115 level swing high. It's turned out to be a resistance zone on 2 occasions, first in August and now in September. The price is attempting to go close to that and receding or falling back. But this time around, the price has fallen below the 25-day exponential moving average. Now, if the bulls are serious about coming back, they will have to convince me by making the Nifty push above and close above sustainably above the 18,115 levels. The bearish trend line, which is connecting the highs made starting from October 2021, has been violated downwards again. So now it will become a resistance area. Coming to the weekly chart on your screen, what you are seeing is a bearish engulfing pattern. The last week's bearish candle has simply engulfed or overpowered the previous week's bullish candle, and that is another red flag as far as I'm concerned. Also note the 18,115 level remains as an immediate resistance area. You need to close above that to be able to push through. The price remains above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull, and the distance, although not as big as the Bank Nifty, is still enough to warranty some more time-wise or maybe even price-wise correction. Now, in the week before last, this index was at number 14 on our in-house volatility rankings. It rose 2 notches. That's a sign of concern. It's now at number 12 on the volatility rankings, which means the challenge for retail traders has just got elevated. Last week, I advocated a range between 18,375 on the upside and 17,275 on the downside, which held perfectly well. In the coming week, I expect a range between 18,075 on the upside and 16,975 on the downside. Here again, please trade extremely lightly. Volatility is likely to remain elevated. Friends, I now come to the risk appetite of the retail traders, and what we are seeing is that whenever retail traders prefer to take a higher exposure in options, they are being on the defensive. And what you are seeing is the percentage turnover contributed by the option, shown as a light blue line, is at a multi-week high, whereas the olive green line, which shows the percentage contribution by individual stock futures, is almost at the previous week's high, but not at a multi-month high. So traders have been taking a very cautious approach. They have been nervous and they are taking a safer options route. So risk appetite on a week-on-week basis seems to be declining. That's another red flag as far as I'm concerned. Friends, I now come to the most popular segment of this video for statistical model traders. If you are following statistical beta or impetus, I gave you a list of 5 stocks which have gained the maximum amount of impetus on Friday. So you take a small exposure on Monday and wait for large price moves, and 5 stocks that have lost the biggest amount of impetus on Friday. So you take bigger exposure, wait for small price moves. This is helpful for scalpers. Different traders, different aptitudes and attitudes, and therefore different strategies. Do remember, this list is valid only for Monday. Should you wish to be updated Tuesday through Friday, please join my Telegram channel wherein I put up this list every day, Tuesday to Friday. So the list of high impetus gainers is led by Bajaj Finserv at number 1, number 2 Bharat Electronics Limited, number 3 Delta Corp, number 4 Vedanta, number 5 Hero MotoCorp. Impetus losers, where you take large exposure, wait for small price moves, is led by PEL, number 2 Syngene, number 3 JSW Steel, number 4 TVS Motors, and number 5 Ashok Leyland. Friends, I'm very keen to hear about how your trading week goes. So do let me know in the comment section about what you experience in the market, what you think of our work, and how we can make our videos even more interesting for you. I love to hear from my viewers, so please keep the comments coming. Before I sign off for the week, a reminder to click like on this video if you liked what you saw, subscribe to my YouTube channel if you haven't already done so, and please help me reach out to fellow like-minded investors and traders and smart guys like yourself by sharing my videos with your social media groups and friends. Thank you for your patience in being with me in this video. Have a very profitable week ahead. This is Vijay Bhambwani signing off for now. See you next week. Bye-bye.